Glad to have you back. Following the current economic headwinds that has characterized the Nigerian operating environment in the outgoing year, Afrinvest West Africa has outlined investment outlook for 2023 and how investors can explore the opportunities and guard against threats expected in the new year. As just concluded Investors Parley, which held in Lagos, the theme soft or hard landing, the lead investment firm highlighted issues around inflationary trend, COVID-19 pandemic, commodity prices, Russia and Ukraine war, among others, as key considerations in investing in 2023. Well, joining me now via Zoom to dissect some of what the issues and, of course, solutions profiled and all that has to do with this document. He is the Managing Director, Chief Business Officer of Optimus by Afrinvest, Mr. Ayodeji Ebo. Good afternoon, Mr. Ebo. It's good to have you join us on the program this afternoon.
Good afternoon, sir. Thanks for having me.
Interesting document. Well, I was able to go through it, but I'm going to start to ask you. Now, let's do an overview of how perfectly can one position as portfolio to optimize returns in 2023. What are those key things you think we should look at? Of course, globally and domestically.
Okay, thank you very much. And for us, in terms of our investment strategy, we've looked at different scenarios and titled it hard or soft landing because there are certain things that would inform whatever direction the market would be. So looking at it from the global space, where we saw the acceleration of rates this year, and we believe that by early next year, inflation should also start to moderate. And if we see the significant unwinding of the increase in rates, we believe that it's really going to be positive for the economy because what we're also trying to see, this tightening, if we're not also careful, if it's sustained and prolonged, may also lead to slow growth rates, which is not good for the global economy. And as a result, would see the Fed and other central banks begin to taper down on the tough stance they've taken to rein in inflation. And looking at it within some of the energy prices that we see that have been high, we know with the with what is also happening when we see the Russia and Ukraine with the peace talks that is also going on and the ceasefire, we believe that if that is also prolonged and that would begin to also bring a bit of stability within the euro area. So we looked at those scenarios. So in 2023, it's really going to be also scenario based, but on looking at crafting your portfolio. So we believe that interest rates would also taper in the first quarter of next year, as the Fed as well as other central banks also try to tame inflation. So in terms of our portfolio weighting, so we're also we've allocated about 50% to fixed income, and we're looking at additional 20% around alternative markets, 15% around equities, look at 10% around CPs and the likes, and also 5% on the PE and VCs. So we are more bullish about the fixed income investment to create some stability. But when you also look at domestically, we believe that with the acceleration of rates that we've seen, there's the base effect that we also expect that will kick in for inflation because the CBN's MPC has also been trying to rein in inflation in Nigeria. So when we begin to see that moderation, we may also see a reduction in the monetary policy rates in 2023. We also did something that I feel would also be very interesting. We did like a demand and supply analysis of the for the fixed income market. The demand, looking at the expected maturities, and the supply, looking at in terms of the absorbing the available liquidity in the market. So we looked at that, and we based on the trend, looking at that analysis, we expect more maturity than what will be issued in the first quarter, which will lead to reduction in interest rates. So it means that for those that want to position shorting the market, you also have to be very careful. You should also looking at it in the first quarter, where you may also want to exit, because we expect that prices would with once prices increase, you can also try to take a position with the expectation that prices will come down. And for the equities market, it's also going to be a mixed bag. We also believe that after the election, it's an election year, we should also see that there will be a bit of clarity towards the end of the year. But something interesting about the equities market we've looked at on a dividend yield perspective, they are now very attractive. You can see stocks that have strong fundamentals that are returning yields of between 12, 15, 16%. So it is also time for investors that have long-term investment horizon and have that risk appetite for the equities market to also begin to take position in tranches as we go ahead in the 2023 election. And lastly, to wrap up this, is the alternative markets, where is also high risk. But if you also work with companies and firms that understand structuring transactions, looking at it within the real estate space, looking at other structured transactions that are very experienced, it's also an area where you gain high return. It's high risk and high return. But if it's properly structured, I believe that the risk will be minimized. So overall, we believe that next year there will be more clarity. There will be reversal in some of the direction that we've seen in interest rates in 2022.
To start, that's a real overview, touching almost all aspects of that report. But I would ask you now, based on the fact that we are moving to an election and the economic disposition of major candidates that you identified in your report, call them as like market-friendly candidates. Can you take us through more, and what are your expectations from whoever, like we always ask, becomes the CEO of Nigeria in 2023?
Okay, thanks. And what would say the recurring factor or the common factor across the top three candidates we have identified is that they are pro markets. So what we believe that part of the thing that is also lacking currently is the socialist mind that we have, trying to subsidize everything. But over time, we've seen that markets will always win. And it now looks like we're suffering from self-inflicted problems based on decisions that we have taken. So when you look at the top three candidates, we believe that there will be decisions that will be taken around the fuel subsidy, decisions around FX, decisions around power, such that government does not need to intervene in these variables, because markets over time would always win. So when you talk about FX, which is one of the very sensitive, so I'm not proposing a free float system. Currently, we use a managed float system. But in terms of the adjustment, the frequency of adjustment, or the rate at which you make adjustments, the delay most times always costs us. So, but if it's market driven, if we see that there's a need because of the demand that we are seeing at a particular time, pending when supply will improve, we make those adjustments. That will build confidence, and we'll begin to see supply. If you use that like an example of any bank, when there's no bank that can survive if there's a run. So if you ensure that there's confidence, you would see people bringing in funds, foreign investors bringing in funds, and that will create a lot of liquidity for the CBN to support. Secondly, the fuel subsidy. So for us, our position is a gradual phase out. Government should be able to show people these savings from subsidies over time, if they save 1 trillion this in the first year, and they can show people this 1 trillion, this is the project that we have used it for. Next year, we intend to save 1.5 or 2 trillion from fuel subsidy. And these are the projects. Just like the way projects are tied to Sukuk bond when they are raised, which is like a project-based fund, bond, that can also be done to provide confidence. The reason why a lot of Nigerians are also agitating is we are not sure where the money would go. And lastly, on power, yes, there's been significant improvement, but for that sector to also thrive significantly, there needs to be cost-reflective tariff. There needs to be less intervention from the government. And it's also been proven based on analysis that have been carried out, also studies that are personally conducted, that debt is one of the sustainable way for the power sector in terms of its impact both in the short run and in the long run. So if we're able to also look at that analysis, it means that even if they are getting long-term debts based on the positive impact and significance it's having in that sector, then there's a need to overhaul and enable that sector to be able to attract private debt and give confidence to the investors. And also, overall, what I would say is that we are hoping and we are trusting that whoever wins, there should be a push for that private sector-led policies that will create jobs and that will improve productivity in the country.
Lot in this document because I was looking at what we should also expect as we move into 2023. Inflation might moderate. That's what I saw in that report. How do you think that would happen? And of course, there's also another likely recession that you're looking at. Well, finally, for me, what is your take with regards to fiscal sustainability, considering our debt profile and all of that?
Okay, thank you very much. And that's also a question that is in mind of every Nigerian in terms of debt sustainability. So when you look at the 2023 budget, which has been projected to about 20.5 trillion and revenue around 10 trillion. But if you also do a critical analysis in terms of what the actual revenue would be, it means that deficit may expand to about 15 trillion. So now you are wondering how will that be funded, which is a major concern. And with what we're also seeing in the ways and means, that increase in money supply from also the support from the CBN is also a major pressure point on inflation. So there's a need to bring down the costs. If we are having the challenge of growing the revenue at this time, there needs to be automation in terms of processes such that leakages would reduce, duplication of duties. Those things would help reduce the cost, because when you look at the projection, even based on projected budgets, almost what will be used for debt servicing is significantly higher than what would be used for capital expenditure. And when we look at the actual performance, even for 2022, the amount, the actual revenue is not even up to what is being used to service debt. It means other sources revenues, either from borrowing, either from ways and means, are what is used for other non-debt recurrent expenditure, which is not sustainable for us as a country. We just would increase our debt profile without the ability to increase productivity. So that's like a major concern that any of the CEOs that comes into position should also focus on. We are not saying sack people, even if you try to rationalize that process for now, there will be a lot of savings in terms of the non-debt recurrent expenditure.
Great stuff there as usual. But let me take 1 minute of your time before you leave, and let's look at the market for today. We have figures in. The market is starting the week low, 0.02% down. Gain as we have FBNH, we have FCMB, we have CAP, Capital Hotel Chains. Losers for today, Access Corporation, Courtval, NACO, NIMET, WAPIC. What is your reaction now directly with the Nigerian market? Seems to have cheap valuations of stocks at the moment.
Okay, thanks. And I like that word, cheap valuation. So it's for those that understand the market, this is the time for them to begin to take position. I would always say in bits or in tranches, because we expect that there may still be some moderation in the market as we approach the election. But looking at the trend, even in the past years, yes, there's always that apprehension when elections come in, but we know election will come and go, and we'll all just focus and there will be more clarity in the economy. So what we would also recommend is, we saw last week, market appreciated, and there's a bit of profit taking way that has started at the beginning of the week. Stocks that have been consistently paying dividend, you have seen their third quarter results, which is strong. And those are the stocks that investors should be positioning now. Because when you look at them on a dividend yield perspective, which is the return based on dividend, you would also be able to earn higher return than fixed income. And if things get clearer, looking at it from the capital appreciation, these are stocks that will give you higher return. When you look at the total return based on your dividend and the capital appreciation, will be significantly higher, and will compensate you for the risk you are taking in investing in equities relative to fixed income. So a certain portion for us is about 15% we're asking investors to allocate to equities, looking at the different asset classes.
I must thank you so much for your time, Mr. Ayodeji Ebo, who is the Managing Director and Chief Business Officer of Optimus by Afrinvest. Do enjoy your week.
Yeah, thank you. Same here.
All right there. Well, I saw you already nodding to that fact that this is the time